Hey guys, it's Sasha. The Federal Reserve has broken the US economy again. This is seriously bad. I make no apology for making this video, apologies for the language that is to come, and just 2 days ago, the Fed left interest rates unchanged at the FOMC meeting, because the Fed has been waiting to see more data. At the press conference on July 31st, Jerome Powell said, if we were to see inflation moving down, more or less in line with expectations, growth remains reasonably strong, and the labor market remains consistent with current conditions, then I think a rate cut could be on the table at the September meeting. So the interest rate at the moment is at 5.5%, and inflation is down at 3.0%. The gap is substantial. The last 2 month-on-month inflation reads were 0% and minus 0.1%. Just before the September meeting of the Fed, we will get August inflation data, and that means that last year's August data will fall out of the 12-month data window. And last August, inflation went up 0.5% in the month. So we already pretty much know where inflation is going to be. If 0.5% falls out and then 0%, like the last 2 months, for example, replaces it, we're going to be somewhere very close to that 2% target mark. It's going to be pretty much at the Fed's target, but it's going to be at that level in August. That's this month that we're in already. It is already here. We're just waiting for the data to confirm it. The big brains of the Fed chose to wait another 2 months for no reason whatsoever. They had a meeting 2 days ago where they could have taken action. But now they are waiting 2 months so that they can see that data printed before taking any action. The problem with the imbeciles in charge of the Fed is that they drive the US economy while staring at the rear view mirror. It's a bit like sitting all day at home, and then it's 9 p.m. and you go, I'm feeling a little bit hungry. So you walk over to the fridge, you open the fridge door, and the fridge is completely empty because you didn't think earlier in the day or the day before, or maybe, a few days before that you might get hungry. So you need to go and get to the shop, but the shop is going to be closed by the time you get there. So you basically fucked up. And this is exactly what we're seeing right now with the US economy. No planning, no analysis, no thinking ahead, no nothing. Just, we have to wait until we see the data. The Fed ignored inflation back in 2021. Remember that? It was transitory. Don't worry about it. There's nothing that needs doing. Rates don't need to go up. I know it's going up, but it's just going to fall right back down all by itself. For the first time in history, these big brain idiots let inflation run all the way to 8.5% in March 2022 before they did the first rate increase. The first increase from 0%. That is insane. It is so incredibly stupid. It was obviously incredibly stupid at the time. I was making videos about how incredibly stupid it is, and it's now even more obviously incredibly stupid in retrospect. And now we have the same exact problem in reverse. We already know that inflation in the US is done. It's over. And I know that there will be those comments saying, Sasha, you don't understand, prices are still really high. And yes, inflation measures the rate of change in the prices. If inflation goes to zero, it does not undo the price increases that have already happened. I've been making videos on my channel over the last year warning that the Fed will over-tighten by keeping rates too high for too long. And here we are. People have stopped spending money because they have run out of money. Here is a chart of the US ISM manufacturing PMI. This is the index of the US manufacturing sector. If it's below 50, it means it's contracting. And it has been sat largely below 50 for the last year and a half. You can see that in the last few months, it's been getting worse. It's been falling. It's the lowest level in the last 10 years, excluding that flash March 2020 crash. And if you zoom out, the only times it's been lower in the last 50 odd years is when there was a major stock market crash. People have stopped spending on non-essential purchases. Yesterday, the Wayfair CEO likened home goods slowdown to the 2008 financial crisis. People are just not buying a new sofa because the old sofa will do. Ford shares post worst day since 2008. Tesla stock tumbles after its profit plunged. Stellantis Q2 US sales off 21% as Jeep Ram struggle. People are not buying a new car because they can fix their old car and drive it for another year, because people don't have the money. The economy overall looks like it's doing okay. US economy grew at a 2.8% pace in the second quarter, much more than expected. But what is driving this? Well, here is the most recent inflation data. The average inflation is 3%, but which numbers on the right are much higher than average, are much higher than 3%. Well, electricity is at 4.4%, piped gas is at 3.7%, shelter is at 5.2%, that's rent and mortgages, and transportation services are at 9.4%. That's almost all down to car insurance. The overall real GDP number is calculated by taking the average rate of inflation out of it, so that you can compare it and see whether the economy is actually growing above the rate of inflation. The problem is that electricity and gas bills, rent and car insurance payments are up way more than average inflation. And until a few months ago, food was also much higher than average. So people are now spending a lot more on basic essentials like paying for electricity, paying rent, and paying car insurance. Things that you have no choice, you have to pay for. And this is translating now into this good GDP data, because they are growing above the average rate of inflation, therefore they are net adding to GDP even though it is just inflation. This is somewhat perverse. GDP is basically now growing to a pretty large degree because of inflation. The Fed has all of this data right in front of them. They had a meeting just 2 days ago, and at that meeting, rates should have been cut. They should have been cut a long time ago, but no. Now we have to wait 2 whole extra months because the Fed is now off on their summer vacation. I shit you not. They actually have a long summer break instead of having their usual meetings every 6 weeks. They should be holding an emergency meeting right now to fix this, but instead, Jerome Powell's got to go and relax on his yacht, right? Intel just announced they are firing 15% of their staff and cancelling dividends. Do you know why? Because people are not replacing their old laptop that is a bit slow with a new one, because they don't have the money. Problem is, you don't see this data at the overall level. The AI hype wave means that companies like AMD and Nvidia, Intel's rivals, look like they're doing great, but go and look at the details. Look at AMD. Data center revenue is up to $2.8 billion from $1.3 billion a year ago. That's over 100% growth. But look further down. Gaming down from $1.5 billion to just $650 million. Embedded, this is processors going into cars and stuff like that, down from $1.5 billion to $860 million. Because regular people are not buying expensive shit because they don't have the money. And here is the Nvidia data. Gaming and automotive grew a little bit, stealing some of AMD's business. Now, if you add them up, if you add AMD and Nvidia together, the total gaming and automotive spend is still net down. But look at the data center. It increased from $4.3 billion to $22.6 billion. That's a nifty 425% increase in a year, and it covers everything. It covers and hides everything else. Tech bros are busy buying GPUs for 4 times the actual price to train their AI models. But here is what's happening in the real world. Amazon shares slide on revenue miss, disappointing guidance for third quarter. McDonald's misses Q2 estimates across the board as consumers pull back on dining out. Disney cuts more jobs as company struggles. Starbucks asks for time with a turnaround as sales slip. People are just not spending money on non-essential purchases. This is very real, it's very serious, and it's happening right now, right in front of our face. And while the Fed is fucking around, changing a word or two in their FOMC statement, the real economy is getting completely battered. And now the stock market is beginning to panic. After a strong first half of the year, the S&P 500 is now down something like 6% in just 2 weeks. And sure, this is all definitely going to help bring down inflation, right? And it's really frustrating because I've been talking about this exact scenario playing out over the past year. If you've watched my channel, you know the videos I'm talking about. I have dozens of videos explaining how this will happen if the Fed doesn't start reducing interest rates fast. And here we are. The Fed fucked up again. Now people are struggling. Small businesses are finding it very hard. Thousands of people are being laid off because Jerome Powell and the other degenerate waste of space losers at the Fed don't know how to read data or do basic analysis. How is it that a random guy on YouTube has been explaining this exact problem for many months now, but now that it's happening, it's a big fucking surprise? Who could have possibly known that keeping interest rates way above inflation for an entire year for no particular reason could, cause problems? Absolutely nobody could have seen it coming, right? And in 2 months' time, at the end of September, the Fed will probably go and do a 0.25% cut. Way too small, way too late, completely ineffectual, because the Fed is incapable of making actual decisions and doing their job. Just like when inflation was up at 8.5% in March 2022, the Fed then increased rates from 0.25% to 0.5%. Complete waste of space. You know what? In 2 years' time, looking back at this situation today, it will be so obvious that the Fed fucked it up, because it is obvious right now. It is evident. But does Jerome Powell give a shit? No. Because Jerome Powell doesn't get laid off when the economy goes to shit. Jerome Powell doesn't struggle to pay for food when food prices have gone up 30 or 40%. Jerome Powell doesn't have to borrow on his credit card to pay the electricity bill. Some people say that if rates come down too quickly, there's a risk of a second inflation spike like what happened in the 70s and 80s. But that argument simply does not hold. The macro reasons for the inflation spikes were entirely different. In the 70s, there was a wage price spiral after Nixon wage price controls were lifted. The inflation spike we just had was caused by the government shitting their pants and printing an insane amount of money during COVID. Completely different mechanisms requiring completely different treatment. Treatment required for a wage price spiral is always much more severe. After the first inflation spike in the 70s, the interest rates also came down way too suddenly and went from sitting just above inflation to sitting significantly below inflation in the span of just a few months. In July 1974, the Fed rate was 12.9%, but by March 1975, just a few months later, it was down at 5.2%, while inflation was still at 10.3%. The problem we are now facing is that deflation has gone from being a remote possibility to being a reasonable probability. There is now a risk that over the next few months, prices start actually falling on average. This is a big risk. The only time this happened in modern history was at the peak of the financial crash, but the reasons back then were very different. It wasn't really the same thing. It was basically all down to oil price collapsing. You can see how oil fell from $140 to just $45 during that crisis. And here's the CPI report from July 2009. You can see that the two big negative numbers are transportation and energy. So back then, inflation was negative, but we didn't see sustained prices falling across the board. It was just oil collapsing in a short space of time. The United States has not seen real sustained deflation since the Great Depression. And the Great Depression was the worst financial crash in history. There aren't many examples of deflation really in developed economies in particular, but Japan hit deflation in the 90s, and their economy imploded as a result, and Japan's GDP is lower today than it was 30 years ago. The big problem with deflation is it's much harder to cure than inflation. It can take much longer too. Just like we're seeing now with non-essential items, we spend on non-essential items, people just stop spending money. And it doesn't take everything. It's not like you stop spending on everything, but even little bits make a substantial difference because prices are falling. So if you wait to purchase something, if it's not urgent, it will be cheaper by the time you do buy it. And that can create a vicious cycle that is very hard to come out of, because you don't spend, you wait, and then the prices fall to try to encourage you to spend, and that makes you want to wait even more because the prices are falling faster. If we do go there, if we do go into deflation, the Fed will be forced to turn on the money printers and print their way out of deflation, doing the exact opposite of what they're doing now, and this problem will be entirely the Fed's own making. If the Fed started to increase rates reasonably back in 2021, inflation will probably never get even remotely close to 10% like it did. If they did their job, we wouldn't have the fucking problem to fix. And then we probably wouldn't have the massive stock market overreaction in 2022. If the Fed started reducing rates at the end of last year instead of scratching their balls, we probably wouldn't need to be reading these headlines. And you know what's going to happen if inflation dips below 2% and starts heading to 0% in the next few months? Jerome Powell and the media will tell you that absolutely nobody could have seen it coming.